I'm Tammy and I'm here today with Anthony Soole, Managing Director of both Property Investment Store and SDA Management Australia. We are here to talk about and release a brand new product that we are so excited for in the property investment space. Now, Anthony, this is a game changer, I think, isn't it?
Yeah, I believe it is. I think that for the last 28 years I've been in this industry, I don't think I've seen anything so unique and exciting and so all-encompassing.
Yeah, it's definitely. What's it called?
Well, Safe Property is the name of the organisation that we're working with, and it's all regarding and all around the idea of fractional investing, which probably is a very unique term that not many people know about. But,
yes, and what does safe, you could probably start by explaining what does safe mean?
Yeah, look, Safe Property was a company name they came up with because it's based on the idea of secure asset, fractional equity. So the idea is that you're investing in property, which is a secure asset, and you're taking fractional equity in that property. In other words, you're buying small portions of a property instead of buying a whole property.
And how does it work?
Well, basically, the idea is that instead of purchasing a complete property, a full 100% ownership of a property, you can buy 5% shares in a property, but still you own that property like you would own the 100% property in the same way, but you're only owning 5% of the time.
So who would you say this is for? Like, I've already got a list in my head of who's going to use this.
I think the main thing is that it's who it's not for. You know, like at the end of the day, there's so many people this suits. We keep talking more and more about different situations, and we realise it suits more and more people that we thought we didn't realise it would suit. You know, I think what it comes down to is it can suit everyone from a young investor who is a young person, might have saved some money and they come to us wanting to buy a property, and we look at the numbers and they can't afford to do anything, and we say, well, look, you know, you can't afford to buy a full property, but you could certainly jump in and buy a small share of a really good top shelf property that's going to get you a far better growth return, far better rental return on the property, and enables them to get in a property which they could probably never get into because they just didn't have enough savings. It could suit a mum and dad investor who might not have enough funding through banks at the moment. Obviously, with interest rates being as they are, things are very tight. They might be a little bit stuck in getting to be able to borrow money. So they might say, well, you know, the bank will lend us $200,000. What can we do with that? So there's an option for them to buy 1, 2, or 3 5% shares in a property like this. Or it could suit someone who's got a self-managed super fund. Same thing again, doesn't quite have enough money in the self-managed super fund to actually buy a full property, but we can use the cash out of the self-managed super fund to buy a number of shares in one or many properties. They could buy 5% in one or 5% in a number of properties and spread their risk out and set themselves up with a really good structure to help with their retirement.
Okay, and so what are we looking at? What sort of money, perhaps a minimum? What are we looking at minimum?
Minimum spend really is for 5% is about $60,000.
Yep.
So you can buy a 5% share for $60,000. You are on title, so when you buy and spend that $60,000, there's no unit trusts or weird strange structures there's no smoke and mirrors. You own that title. You are a 5% shareholder of that property on title and from $60,000.
Okay, great. So we've got the basics down. I'm going to hit you with all of the frequently asked questions.
Go for it.
Everyone, I think, when you hear about a product like this, the first thing is you think, well, what's the catch? Is it too good to be true? I'm going to ask you a whole bunch of frequently asked questions that some of our clients have asked, some of our property strategists have asked. So let's work our way through this.
Just see if I can remember all these, because it's a new product, so this will be a test for me too.
So can an SMSF buy shares, obviously with cash,
to purchase one of these? Yes, they can.
Yeah.
I mean, that is the big thing. I mean, a self-managed super fund is not allowed to buy a 2-part contract, in other words, a house and land. They can only buy a single-part contract. The problem with that is that most single-part contract properties, to be honest, are pretty rubbish. Like they're either a unit or apartment or a villa or a duplex or something that can be very expensive even, or be not real flash, it'd be a cheaper house and the quality is not going to be good. It might be an older place, which is all very well and good, but what sort of growth are you getting on it? What sort of rental return are you getting on it? And what sort of overall picture is that going to be in a sense of expenses. So yes, they can buy it. It's a very, very good way and unique way for them to be able to jump in and buy something.
Okay. And look, it is exclusive to Property Investment Store. We are exclusively working with Safe Property.
That's right.
But who's an investor working with? How many people are buying into a property?
Well, basically it's split up so that the prime investor, which is Safe Property, owns a 65% share of the property. Then it's broken up into 7 other investors, 7 other 5%ers that can all come in and buy.
Okay.
That might be made up of 7 different people buying 5% each, or it could be one person buying 15%, the rest buying the rest each. It depends on how many people want to be involved in purchasing that property and what percentages they want to purchase. But yeah, ideally it's split up into 7 investors, then plus Safe Property as being the main investor, 65% holder.
Okay. And so I've bought a couple of shares. It's a few years down the track and I want to sell. Does everybody have to sell at the same time? How does that work?
Good question. No, because it's set up as a tenants in common type structure, you own that share of your property and you can effectively sell that share of your property. You can decide what you want to do. If you now under the rules of the structure that's set up as Safe Property, they get the first right of refusal to buy it off you. So when you go to sell it, they say, well, give me a look at it. If we're interested, we'll buy it. There's a good chance they will. But let's say they don't, and they say, oh, look, we're not in a position right now. We don't want to do that. Well, Property Investment Store are happy to promote that to our other clients in the future that would want to buy into a going concern in this market, because we believe there'll be a lot of clients who also want to buy something that's up and running, getting a rental income coming in. They can see it, they can touch it, feel it. They'll want to buy into that sort of market too. So, the exit strategy, if you don't like that and you want to go to your local agent, property manager, whatever, you can sell it through them. They might be a little bit confused, a little bit struggling with the concept. But that's why we're probably more of a chance to sell that for you and get that sold.
And we're going to have that database there. We're going to be having more onboarding clients that are wanting to come and purchase this.
Totally, yeah, we will. Yeah.
Okay, so can I buy more than a 5% share? Can I buy 7?
Yeah, look, you can buy all 7 if you really wanted to.
Yeah.
I mean, there's no stopping to how many shares. There's no stopping to how many different properties you buy into. We'll have a number of different locations going at any one time that people can choose from. And they can look at it and say, well, I want to buy 3 shares. I might want to buy one there, one there, one there, rather than buying all one into one property.
And the old school putting your eggs in
one basket, spreading out your risk. Yeah.
Yeah. Okay. And how often is the rent paid? Let's have a look now at what the rent side looks at it and how you get return back on your investment.
Look, the good thing about the rent is it's paid monthly, and the returns on these are very good. We are focusing on our own product, which is what we specialise in as Property Investment Store, NDIS, SDA products. The reason why Safe Property decided to journey with us is because we own our own property management business.
Yes, and that is the key.
That is the key. We can get tenants. Yeah. We've got other podcasts and other webinars you can watch of ours in regards to Property Investment Store's NDIS, SDA products and what we do there. But the key is about property management, and we know we can get the tenant. We know we can get the good returns. Okay. We're saying in these properties we can project 11 to 12% return with the sort of properties we're doing, because these are top shelf properties. These are good style, dual income style ones where we can get a few tenants in these NDIS properties that we know we can get, not the fake ones that everyone else says they can get. And at the end of the day, that's a real return we believe we can get. So, we're talking about a $60,000 outlay for the potential of 11 to 12% return. Something you own on title. Yeah. Where else are you going to get that?
Yeah, exactly. Okay, so we're looking at 11 to 12 conservatively returns. What am I looking at for a deposit? How does that side look?
Yeah, look, with a deposit, normally once we decide on the property, you put about $2,500 down, and that then puts your foot on the contract to purchase a share in that property. They get the contracts organised. It takes about 48 hours. We've got a solicitor who's happy to help us with that and work with you with the contracts, the agreements to make sure it's all right. You then go into the agreement with Safe Property. Safe Property then organise the build and construction of the property, which might take obviously a few months to construct, 7 or 8 months in most cases. Yep. But once it's finished, then basically the company that is building the property that they have as their build company then assigns the property over to all of the shareholders as a tenants in common, and everyone goes on the title at that point as a single contract property. Okay. So it's done very seamlessly. It takes a while to build, obviously, because we're building a construction property, but at the same time, you're getting that growth throughout that time, and there's not really that much outlay in the sense of interest. I mean, you're paying the cash in most cases. You can borrow equity out of your own home to invest in this, which is a good idea too. So.
Okay, so can I borrow any of that 60,000, or do I need to actually pay cash in that sense?
Yeah, look, you can borrow against your own home. So if you've got equity in your home, you can actually get the redraw equity out of your own home to put into it, which is effectively then like you're putting in as cash. Over the property itself, the only person that can take a loan over that is the 65% shareholder.
Okay.
So the other 5% are all cash input people. I did have someone ask if they could buy a 5% share with their Amex, and the answer is yes, as long as you pay your fees. So yes, you can get all the points, and you can do that, but as long as you pay your fees, you can do it. So there's many ways you can go about buying it. Obviously, the super fund, cash out from the super fund, real cash in the bank people have, they can put into it. People who are getting 3 or 4% in the bank, they can whack money into this now.
That's when it's a great, like, there's quite a number that might have 100,000 sitting in there, and like you said, earning such a dismal amount.
We see a lot of clients that got cash in the bank.
And now have it something a bit more secure than
property.
Shares or property. Exactly.
You own.
Now, who's going to manage the property?
Yeah, look, the property management's done because they're SDA properties. In other words, they're through the NDIS, the Disability Insurance Scheme. They're run by our management company, which is SDA Management Australia, and we look after. We're an authorised NDIS service provider, so that means we're allowed to look after the management of NDIS SDA homes. You have to specifically be qualified to do that, to be able to get the money from the NDIS to be able to pay the investors. So we've got about 100 homes we've built in this space now. We have about a 95% occupancy rate with that business. So we know we can get tenants in these homes, and when it comes down to it, we'll do the management on it because we know how to do it properly.
Okay, and do you update me on?
Yeah, you'll get regular statements. Every month we're the whole idea of this is transparency. There's no hiding of anything. Every month you'll get the statements to show what was paid as a total. You get paid whatever comes in. So if it's only 8%, you're going to get 8%, right? But ideally, these properties that we're doing, we know the numbers should be more like 14, 15% from the balance and the structure that's done.
We do have some.
We do have them like that.
Getting those.
That's right. So we know we can get those returns. But what we're saying is that it's all real. You pay your 5% share of any costs. You get 100% share of any, a 5% share of any 100% of what's coming in the sense of rent.
Okay.
Obviously, that's management fees, things like that. But the idea is that there's nothing hidden in this. There's no extra costs or monthly ongoing fees. Maintenance is part of it as well. You'll pay 5% like any investment.
Like any investment property, you just own a portion. Okay. Can I live in the property that I'm invested in?
Yeah, good question. No.
Okay.
No, can't live in it. That was one of the stipulations that we did. Obviously, was part of the structure. Was you're a 5% shareholder. There's no advantage like that. It's purely an investment, purely about trying to make some money over the time.
Okay. Now, I think this is a really cool point because normally there is no guarantee when you invest, but this product actually does come with a bit of a rental guarantee.
Well, it does for the first 3 months.
Yeah. Okay.
So we sort of allowed for between Safe Property, who were offering the guarantee. We sort of talked about it. We said, well, look, we believe, we've got a good track record of being able to get tenants quickly.
Yes.
But they were happy to offer, for the first 3 months, an 11% guarantee, which is pretty strong. But at the end of the day, that's what we believe we're going to get. After.
So we're going to guarantee that for that first.
For the first 3 months, if we don't have that tenancy coming in.
And look, I've seen the girls at SDA Management Australia, the way they run and the way they start marketing their property very early on, which I think that's a real key. That goes for all of the other properties that we manage as well. And what probably the last thing is, it's the thing that comes at the end of the financial year, is tax. What sort of tax implications are we looking for?
Look, obviously, there's income coming in. There'll be some small deductions on the loan and interest. If you borrow the money, there might be some interest deductions there. But ideally, from a tax point of view, there's not a lot of claim involved in the property because you're only a 5% shareholder. But the idea is that you're owning it in the super fund. That's a very strong way of owning it because there's only 15% tax rate in a super fund. It's obviously a massively powerful way of owning it. We did some numbers the other day when we were running, when I was sitting down with Raymond, who runs Safe Property, and we did some numbers the other day. It was quite amazing to see that we had a client that could effectively have bought 3 5% shares to start with, and at 50. But by 65, we designed it so that their super contributions and their rent going in I think it was every 2.5 years, was enabling them to buy another 5% share. By the end of their retirement, they ended up having 13 5% shares, right? Which meant that they were getting tremendous amount of income coming in, and also all the growth of those properties over the time.
On property that they own.
That's it.
They own that percentage.
That's right. Or another client we spoke to the other day, very, very keen to get their kids, 3 kids, and they were looking at buying a property through us, and they had a little bit of extra capacity left over to do something. And I said, well, why wouldn't you look at using some of the equity from your home? $180,000, buy 3 shares, one each of the kids. You can buy them in 3 different properties.
I love that idea. Right? It's like a little trust fund.
Yeah, totally. But the idea is that the kids were like 12 and 11 and 9 or something like that, right?
Yeah.
But the main thing is that they could keep them for the next 10, 12, 15 years. The rent coming in was going to service all the debt anyway.
Yeah.
So it wasn't going to cost them a cent to have that $180,000 borrowed, because the money coming in was servicing the loan, servicing the debt. So effectively, all that time then, while the kids are growing up, they've got this beautiful little trust fund sitting in the background. And then when they get to the age where they might want to actually have a job or might want to invest themselves, they can sell that 5% share, pull that money out, and then they can start on their own investment journey with their own property. So it's a crazily good way of being able to empower your kids' opportunity to invest and set them up for the future.
And break into the property market. So for those who've always struggled or feel like they're not really being able to save a deposit as fast as the property is growing. Is there anything else I've missed that you want to add, or do you want to summarise?
Well, to be honest, it should be that simple. This is not meant to be a 4-hour discussion. The product is simple. 60 grand to get in. You're buying a share, 5% share in a property. You're going to get between 11 to 12% return is what our target number is. And I believe it's a realistic number based on, because we're controlling the management, we know what we get. This is 2 companies that come together that know what we're doing. You've got Supervest, which is the company who's created Safe Properties. They do a lot of in the superannuation space, so they understand from accountancy background how to structure that. They came to us because they know we're good with our product and our management. So the key thing is, we've got 2 companies that have combined together to create what I believe is one of the most innovative and powerful products that I've seen. Because, as I say, when we deal with people generally in the general property investment market, we're probably dealing with the tip of the iceberg, which is the 20% of people. But you've got 80% of people under the water, right? And that's the iceberg, that's the big bit of the iceberg. And all those people, they're just struggling, thinking, I can never get ahead in my life. I can never create anything. I can't leverage myself. I can't start something. How do I make money if I haven't made anywhere? And they can't chase the market if it's in the bank account. So there's an opportunity for them to invest like they've never had a chance to do before.
This is great. So that was really good, really informative. Thanks for explaining it. We think this is something that is really going to change the way you invest and allow a lot more people into investing. Thank you.
No worries. Thanks for having us.